Hi everyone. In this lecture video, we will be talking about the accounting standards for the property, plant, and equipment, which is Philippine Accounting Standard 16 or PAS 16. This lecture video will be divided into 4 parts. For part A, we will be talking about the basic concepts, inclusions, and exclusions under PAS 16. For part B, we will be talking about the acquisition through exchange, trade-in, and issuance of bonds and equity. And for part C, we will be talking about the cost model and depreciation method. And for part D, we will be focusing more on the revaluation method, the changes in the accounting estimates, and other topics. To start, let's talk about the characteristics of property, plant, and equipment, or PPE. The first thing that you have to remember, since we are talking about a property, plant, and equipment, it should be a tangible asset. When we say it is a tangible asset, it means to say that it has a physical substance. When we are talking about assets that don't have any physical substance, it means to say that it is not under the measurement of PAS 16. The next thing that you have to remember, when we are talking about the characteristics under the PAS 16 is that it should be used in the business. Any types of business, it can be for the use of the production or for the supply of goods or services. It can be used for the administrative purposes or it can be used for the rentals. Aside from having a tangible property and it is being used in the business, it should be long-term in nature. When we say long-term in nature, we are expected or the asset is expected to be used more than one accounting period or more than 1 year. Now let's talk about assets considered as PPE. There are 3 common types of assets considered as PPE. It can be land, it can be a building, or it can be a machinery or equipment. So let's talk about land. So if the land is being used for the business, it is being held for future plant site, those kinds of land will be considered under PAS 16. So there are types of lands or type of land that are not considered as part of PAS 16, but they may be considered as part of investment property. For the building, if it's being used for the business, then it can be considered under the PAS 16. With respect to the equipment, if it is being used during the production or for the production of goods, or it is an equipment held for rentals, or it is an equipment being classified as furniture and fixture, those are the equipments or machinery that you will be recognized under PAS 16. Now, let's talk about other assets to be recognized under PAS 16. We have here the major spare parts, and we have here the bearer plans. When we say major spare parts, these are the parts of your machinery and or equipment that is very integral or very critical for you to use the equipment. When we say bearer plants, so it is a plants that has the capacity to produce fruits or vegetable. Now let's talk about assets that are not going to be measured under PAS 16. Let's talk about first land. If the land is being held for speculation or it is being held for an undetermined future use, both of these types of land, the one held for speculation and the one held for undetermined use, is to be considered under the investment property or under PAS 40. So let's say we have here a property, but the nature of the business is to sell a specific property. For example, we are talking about the real estates. Okay? So the normal course of business of a real estate is to buy land and to sell properties. If that's the case, then the properties being held for sale in the ordinary course of business will be considered under the inventory. Held as inventory. Now, let's talk about the spare parts. So if it's a minor spare parts, it is not to be considered as part of property, plant, and equipment. Then, for a biological assets, if it's related to the agricultural activity, then it will not be going to be considered as part of PAS 16. Keep in mind that if we're going to consider biological assets, only the bearer plants is to be considered under the PAS 16. Just to summarize, if the assets, for example, land, building, and machinery, is to be used in the business or as future plant site, if we are having a major spare part, and if it's a bearer plant, then it will be under PAS 16. But if it's not covered under those specifications, then we will not going to measure a specific asset regardless if it has a characteristics like physical substance or it is to be used on a long-term basis, then it will not going to be under PAS 16. Now, let's talk about the recognition principle of PPE. The first thing that you have to remember is that there should be a probable future economic benefit. Take note that when we say future economic benefit, we are referring to the inflow. The next thing that you have to remember, if we're going to recognize a specific PPE, is that its cost can be measured reliably. To summarize, if a PPE is both probable and measurable, then you will recognize it under PAS 16. Let's talk about the accounting treatments for spare parts, standby equipment and servicing equipment, and for the safety and environmental equipment. If we're going to recognize spare parts, standby equipment, and servicing equipment, it should be expected to be used for more than one accounting period. For the safety and environmental equipment, they are usually recognized as PPE, although they do not directly increase the future economic benefits of other existing assets. This safety and environmental equipment will be an inclusion to the PPE. Let's talk about the initial measurement for PPE. Initially, all PPE is to be measured at cost. Then let's talk about what are the components of the cost. We have here the purchase price. The purchase price, if it's being sourced out from the other countries, that will include import duties. Then here in the Philippines, we have here the concept of value-added tax. If there are non-refundable tax being included, then you have to include it as part of the cost. But if the tax being included in your purchase price is a refundable for the likes of value-added tax, then that should be removed. Less value-added tax plus non-refundable tax. After deducting the refundable tax and including the non-refundable tax, then we should be able to deduct any trade discounts and rebates. after considering all of the acquisition costs, then you have to add in the initial measurement all directly attributable costs. After adding all the directly attributable costs, you have to include all of the initial estimate of dismantling, removal, and site restoration. These are the costs that you have to remember if you're going to have a correct initial measurement of PPE under PAS 16. Let's try to illustrate. So let's say we have purchased a specific machinery or a specific asset on January 1, then we can now use the specific asset on March 31. It means to say that all of the costs that you will incur prior to the March 1 for as long as it is necessary for you to use specific assets, then that will be included as part of the inclusions. Then, for example, on March 31, you can now use a specific asset, then you still incurred a cost, then that will be considered as part of the exclusions. The key takeaway here is that you will record the costs that are necessary for you to use up to the point of intended use or purpose. It means to say, beyond the point of intended use or purpose, those costs will be included or will be characterized as an outright expense. But if you, let's say, on January 1, this is your purchase date, then up to the March 31, you can now use the assets. Let's talk about the costs that can be capitalized under PAS 16. Since there are some assets that will be going to require for a site preparation, the cost for site preparation is going to be capitalized. Then, for example, the asset is to be delivered from other countries, then the initial delivery and handling cost or freight is to be considered as capitalizable. Then, for example, you have bought a personal computer, then it will require a specific installation or assembly cost, then it will be considered as capitalizable cost. Then it will also include some testing costs, net of disposal proceeds. You can also include the professional fees for as long as these professional fees is directly attributed for the intended use or purpose of the assets. And you can include the testing costs for the acquired asset. Now let's talk about costs that are to be considered as an outright expense. Let's say you have opened a new facility building. The cost that you have incurred during the opening of the new facility will not going to be considered as part of the capitalizable cost. Then, for example, you would want to conduct business in a new location, then the cost of introducing a new product or the cost of conducting business in a new location, those costs will be recorded as an outright expense. Then all of the administration and other general overhead costs are not going to be included as part of the capitalizable cost. Let's talk about the measurement of cost. When we say cost, it is to be measured at cash price equivalent at the acquisition date. When we say that we will going to measure a specific asset under PAS 16, then we should always look for its cash price equivalent. If the payment is being deferred beyond the normal credit term, then you will recognize the difference between the cash price equivalent and the total payment as part of its interest. Interest is equal to the total payments less the principal. It means to say that if the principal is lower than the total payments, then it should be understood that the excess is to be attributed to the interest. let's talk about different modes of acquisition. When we say cash basis, then we have an enough amount of cash for you to purchase the asset. As part of the cash basis, then obviously we will record the purchase price. Then aside from recording the purchase price or its cash price equivalent, then we have to record the commissions. Commissions to broker. Then import duties. Then we will include the non-refundable purchase taxes. If there are assembly costs or installation costs, that will also be included. And if we have the proceeds from the sale of a specific asset, let's say we have a net proceeds from the samples generated, the amount coming from that will be deducted as part of the initial cost of a depreciable asset. Under the cash basis, these are the costs that you will commonly encounter when you are going to record a specific depreciable asset. Again, if you will going to see an administration cost or general overhead cost or advertisement and promotion cost, those two will be excluded or will be treated as an outright expense. So how are we going to record the cash purchases? Since we have acquired a specific asset using cash, then we're going to debit whatever is this asset, then we're going to credit cash. Then, for example, you have encountered general and administrative expense, and for the advertising expenses, we will going to debit expenses, then credit cash. This will be your pro forma journal entry when you will purchase a specific asset using cash. Now let's talk about another way to acquire an asset, and that is on credit or on account. When we say on account, you will purchase an item not by using cash but by using credit. Sometimes the purchase price includes value-added tax or includes refundable taxes. Then what you're going to do is that you're going to divide the purchase price by 100% plus the VAT rate. In this case, since I am in the Philippines, normally our VAT is 12%. So we will going to divide the 112,000 by 112%. So we have here the purchase price that is VAT exclusive amounting to 100,000 pesos. Then always remember that the purchase price under PAS 16, it should always exclude any refundable tax. That's why we are dividing it, or that's why we are dividing the 112,000 by 112%. Then take note that you're going to deduct on the VAT exclusive purchase price any cash discounts that you will avail. Let's say the cash discounts here is 5,000 pesos. Then our cash price equivalent will going to be 95,000 pesos. Let's have the journal entry on this one. We're going to debit the equipment or whatever will be your assets that you're going to acquire, 95,000. Then we're going to have a debit on the input VAT. Since we are the one or we are in the point of view of the buyer, our value-added tax or input VAT here is the difference between the VAT exclusive and the VAT inclusive, and that is 12,000 pesos. Then we're going to credit accounts payable by the total of the equipment, 95 plus 12, that will be 107,000 pesos. This will be your journal entry if you're going to acquire a specific asset on account. Just to summarize, our measurement for the cost specifically for the past 16 is that you should always look for its cash price equivalent. Then our interest is to be computed as the excess of the total payments over the principal of the loan. Then if you're going to purchase an equipment using cash, please exclude the net proceeds or please deduct to the initial cost the net proceeds from the sale of the asset. Then if you're going to purchase an asset on account, always see to it that you're going to deduct the refundable tax. Only non-refundable taxes are to be included as part of the cost of a PPE. Now, there's a caveat for the value-added tax, especially if you are going to refer for entities here in the Philippines. If, for example, you are not a VAT registered payer, then the VAT paid is to be included as part of the cost. So let's say you're in the point of view of the buyer, you are not a VAT registered, then you cannot pass on the value added tax to another entity. That's why the 12,000 pesos here that you can see will be added up to the cost of the equipment. This will be your journal entry if you are not a VAT registered. Then, for example, the payment is made beyond the discount period. Because if you will notice, we have applied the net method. Then let's say that after applying the net method, then the payment is made after the discount period. Then take note that the 5,000 pesos will now be lost. Okay? So we will debit the accounts payable since we are under the impression that you're going to pay the accounts payable for the whole amount, 95,000. Then we will have here the purchase discount for feature and we're going to pay it in full price. Credit cash, 100,000 pesos. Then this will be our journal entry if we're going to pay beyond the discount period. Let's talk about another modes of acquisition, the deferred settlement. For this one, we will have two kinds of scenario. The one is with cash price equivalent, and the other one, it doesn't have cash price equivalent. And the other one, we will be talking about deferred settlements without cash price equivalent. Let's have here as this example. So on January 1 of the current year, we have managed to purchase an asset on a deferred settlement basis. We have here the installment price, which is 130,000 pesos, and the cash price equivalent of 100,000 pesos. Then you can avail the deferred settlement or the installment basis if you're going to have a down payment of 10,000 pesos. Then the remaining balance of 120,000, you will be paying it on a semi-annual installment. Take note that the total down payment and the total payments, in this case semi-annual payments, should also be equal to the installment price. So basically it should be the same. Okay? Then now let's record the journal entry for this one. Again, since the beginning of the cost measurement of past 16, we're going to use the cash price equivalent. On January 1, we will going to have a debit equipment using its cash price equivalent, and that will be 100,000 pesos. Then we're going to credit cash for our down payment, 10,000 pesos. Then we will going to record a liability. The liability here is the total payments. In this case, the total semi-annual installment payments, that will be 120,000. The total debit is lower than the total credit. So that's why we will going to record discount on note payable amounting to 30,000 pesos. This will be your journal entry if you're going to record or if you're going to have deferred settlement with cash price equivalent. Take note that the difference between the total payment and the cash price equivalent is recognized as interest over the credit period using the effective interest rate method. Okay, so let's have here an example on this one. Since we have here the installment price of 130,000, then the cash price equivalent is only 100,000, then we will have or we will going to record an interest amounting to 30,000 pesos. And this 30,000 pesos is to be recorded under the effective interest rate method and to be recorded over a period of time. Okay? So a recap, for the deferred settlement with cash price equivalent, we will going to record or we will going to debit the equipment using its cash price equivalent amount. Then we will going to have a credit if we're going to pay for a down payment, credit cash. Then we will going to record a liability since we are going to have an installment method on this one. Or we will going to pay it by installment. Now let's talk about the deferred settlement with no cash price equivalent. In this case, it will be a little bit more complex because we will going to be using present value. So let's say same example on this one. The installment price is still 130,000 pesos. Then we're going to pay 10,000 as our down payment. But in this case, the 120,000 will be on a 3-year annual installment for simplification purposes only. So I'll write it down. Again, we have to consider that the installment price is equal to the total of the down payment and the annual installments. In this case, we have an annual installment of 40. Therefore, we can have an understanding that it will take 3 years for you to come up with the total of 120. And 10,000 down payment plus the 120,000 total annual payments for the period of 3 years, that will be equal to the installment price. Let's have an illustration on this one. Let's say that the down payment, of course, since this is a down payment, you're going to pay it at the initial date of the transaction. Let's say we have here January 1. We're going to pay 10,000 pesos. Then every year, we're going to pay 40,000 pesos. This is December 31 of year 1, 40,000 pesos. Then December 31 of year 2, another 40,000 pesos. Then lastly, December 31 of year 3, we're going to pay our last installment of 40,000 pesos. Then the concept of present value is that we're going to bring it back to the present. Here, the effective interest rate of 12%. So for the year 1, we're going to use the formula of 1.12 raised to negative 1. Then for the year 2, we're going to use the formula of 1.12 raised to negative 2. Then for the last installment, we're going to use the formula of 1.12 raised to negative 3. I will be using a scientific calculator to compute for the present value on this one. For the first year, rounded off by 3 decimal places, we will going to use 0.893. Then for the year 2, we will be having a present value factor of 0.797. Then for the year 3, we will have a present value of or present value factor of 0.7712. Okay? Then let's multiply the 40,000 to its present value. 40,000 multiplied by 0.893, we will going to get 35,720. Then the next one is 0.797. We're going to get 31,880. Then for the year 3, 40,000 multiplied by 0.712, we're going to get 28,480. In this case, the 10,000 pesos down payment, we will not going to use the present value factor because there's no passage of time on this one. If we're going to total the 10,000 pesos plus all the present value of the future payments, that will be 28,480 plus 31,880 plus 35,720 plus 10,000 pesos, you will have 106,080 pesos. This is your initial cost of the equipment if you're going to use deferred settlement with no cash price equivalent. If you will notice, or in actual practice, let's say for example, you have a deferred settlement of 10 years, then you have or you're going to compound it on a monthly basis, then it is very impracticable to have the present value on a per period basis. So we will going to use the present value of an ordinary annuity on this one. So the concept of the present value of ordinary annuity is that you're going to have a total of each present value factor. So we have here 0.893 plus 0.797 plus 0.712. Then our present value factor that we should be using here is 2.402. Then there's a mathematical formula, a specific mathematical formula for the present value of ordinary annuity, and that will be 1 plus I raised to n, negative n. Then we're going to deduct 1 from the answer on that one divided by our I. Okay? So again, our I here is the interest divided by the frequency, and our n here is, this is our time multiplied by the frequency or the number of times that you will going to compound your interest. In this example, it's very straightforward. We will be using annual installment for 3 years. So our I here will be 12% because 12 divided by 1 is 12. 1.12 raised to negative 3. That will be 3 annual installment multiplied by 1. For our frequency, that will be negative 3. Then whatever is the amount that you will get, you will going to deduct it by 1, then divide it by 12%. Then you will be arriving with almost exactly the same answer, that is 2.401 as your present value factor. Okay? Then use this present value factor, 2.402, 10,000 plus 2.402 multiplied by 40,000, you will be having 96,080. Then you will be arriving with the almost exact answer, 106,080 pesos. If you have found that the procedure is quite fast, then you can pause, then slow down the video playback so that you can have an absorption on the concept that I have provided. To summarize this slide, so again, we have here a new modes of acquisition, the deferred settlement. If there is a cash price equivalent, you're going to use the cash price equivalent as your initial cost of the asset. But in another case, if you don't have any cash price equivalent, then you're going to discount the amount of installment, then use the present value. So you can manually use the present value of every installment, or you can use the present value of an ordinary annuity. Here is our formula for the ordinary annuity. I'll box it in red. You can use this formula in our future discussion when we will be talking about the present value, or when we will make use of the present value. Now let's have the journal entry on the deferred settlement with no cash price equivalent. We have here our asset, or in this case, let me just go back. We have here our equipment. Again, you will going to measure it based on the total present value plus the down payment of 106,080 pesos. Then you're going to have a credit of cash for your down payment, 10,000. Then you're going to have your notes payable or any liability account that you will be using, 120,000. Then get the difference of these two. So that is 120,000 less 106,080. That will give you 94,080. This 94,080 will be recorded as part of your discount on notes payable. This will be your journal entry for the deferred settlement with no cash price equivalent. Let's have the table of amortization on the following installment. Let's have the date, the cash payments, or the installments. Then we will record the interest expense, then the amortization, and for the last column, we have here the present value. For the date, let's have here January 1 of year 1. Then we have here December 31 of year 1, December 31 of year 2, then December 31 of year 3. Then for the cash payments, we have here 40,000, 40,000, and the last 40,000 pesos. The interest payment is that you're going to base it on the present value. The present value on January 1 of the year 1 is going to be 96,080 or 96,080 pesos. Then take note that you're not going to include the down payment in the table of amortization. In this case, 96,080 pesos, we're going to multiply it by 12%. We will have here the interest expense of 11,530. I'll just round it up. Then for our table of amortization column, we will going to subtract 40,000 less 11,530. We will get 28,470. Then the 28,470, you're going to deduct it to your present value. And that will be 96,080 pesos divided by 28,470. You will have an updated present value of 67,610. Then let's continue the process on this one. 67,610 multiplied by 12%. We're going to have 8,113. 8,113 less 8,113, 40,000 less 8,113, we will have here an amortization of 31,887 or 31,887. Then you're going to deduct it to the updated present value, and that will be 67,610 less 31,887. We will have 35,723. 35,723 multiplied by 12, then we will have here 4,287. 40,000 less 4,287, that should be roughly equal to your previous present value. Okay? So it means to say that the present value of 35,723, you're going to write it here in the column of amortization for you to make it zero or to avoid any rounding off error on this one. Okay? So at the end of the day, the if you're going to use a table of amortization, then the last day of the amortization or the last row of the table of amortization should be zero on this in this case. Let's have a shortcut on this one. Let's say the problem is asking you, what is the present value of the notes payable on year 2? Okay? So in this case, since we are on the year 2, then expectedly, there is only one remaining year for the table of amortization. And that will be 1 plus 12% multiplied by negative 1. Okay? That will be your PV factor. Whatever is the amount that you will get here, 1 minus the answer on this one, divided by the 12%, then you're going to get a factor of 0.893. I rounded it off by 3 decimal places. Then you're going to multiply it by 40,000 pesos. You will get 35,713, which is closely related to the 35,723. Then let's have the journal entry by the end of December 31 of the year 1. Since we have paid a 40,000 annual installment on this one, then we're going to have a debit on the notes payable amounting to 40,000 pesos. Then we will have credit cash, 40,000 pesos as well. Then, aside from paying the 40,000 pesos, then you will record an interest expense amounting to 11,530. Debit interest expense, 11,530. Then we will going to record a discount of exactly the same amount as to your interest expense, discount on notes payable, 11,530. This will be your journal entry for December 31, year 1. Let's talk about incidental operations. Let's create a timeline on this one for us to have a better illustration on this. The line in yellow ink is the point wherein we can now use the asset for its intended purposes. The point of the incidental operations will happen before or during the construction of the PPE. I will highlight it in red. So the areas that will come along before the point that you can use the asset will not going to be measured as part of your PPE. Therefore, if the asset is not yet being erected or if the asset is not yet being constructed, then the incidental costs happen before that point, then all of the incidental costs from that will not going to be included as part of PPE or not to be considered as part of PAS 16. So for example, we have here a vacant lot that will be used temporarily as parking space. So all of the income and related expenses from the parking space, that will be recognized in the profit or loss. But it will not affect the measurement of the cost of PPE under PAS 16. For the self-constructed assets, it will include, of course, the cost itself or the cost of constructing the asset itself. But it will exclude internal profits. So for example, we have here savings on self-construction. We're going to deduct it to the cost of self-constructed asset. We're going to deduct also the cost of the abnormal amounts. Abnormal amounts includes wasted materials, labors, and other resources that are being incurred in the self-constructed asset. Let's talk about classes, definition, inclusions, and exclusions under PAS 16. Let's first have the land or the property. Land is classified as PPE if it's used in the entity's operation as owner-occupied. Kindly take note of this concept. If the land or property is not owner-occupied, then it will not be measured under PAS 16. What are the example on this one? So if we have a land on which the entity's office is being constructed or the land used as plant site, those are the example of owner-occupied property. Let's talk about the inclusions of the land. Of course, we will include the purchase price. The purchase price, the purchase price will include other necessary costs such as broker's commission or land registration, etc. Then we're going to include the titling costs, attorney's fees, and the registration fees in the land registrations office. Then we're going to also include the cost that you're going to incur to get the land in its condition for its intended purposes. So for example, we have here the surveying, we have here the grading and clearing costs. We will call it as a necessary cost or required cost. You cannot use your land for its intended purposes if you will not going to incur these following expenses. Then of course, you're going to add up any unpaid taxes prior to the date of acquisition. So again, to summarize, we're going to include purchase price, the necessary costs, and any unpaid taxes prior to the date of acquisition. Let's talk about lands that are being excluded or not classified as PPE. So again, if the land is being held for the normal course of business, that will be measured under inventory. Then if the land is being held for the long-term capital appreciation or for undetermined future use, or the land is being leased out under operating lease, if you can see all of these indicators, you will not going to record it under land using PAS 16, but you will going to use the accounting standard for the investment property. Let's talk about land improvements. When we say land improvements, these are the enhancements to the land. Then it can have an indefinite useful life or definite useful life. An example of land improvements that have definite useful life are, we have here, for example, walks, drive walks, or parking lots, drainages, and cost of the trees, plants, and other landscaping. So basically, what you will going to include as part of the beautification of the land, that will be considered as land improvements. Then let's talk about the land improvement that has an indefinite useful life. When we say land improvements that has an indefinite useful life, it means to say that they are not subject to the depreciation. Unlike with the definite useful life, all of these, the driveways, the parking lots, the fences, the trees, or the landscaping, all of these will have a depreciation. Therefore, land improvements are segregated from the cost of land and depreciated over the estimated useful life. Let's talk about building or plants. For you to include or to classify it under the PPE, buildings or plants, it can be self-constructed or you can acquire it. Regardless if it's self-constructed or acquired, for as long as it is being occupied by the owner, then you can measure it under PAS 16. Let's talk about the inclusions that we're going to record for the purchase building. First is that we have here purchase price plus the legal fees plus if there's any commissions, broker's commission. So that is the first thing that you have to include as part of the building. The next one is that you have to include the option to pay or the option to acquire the building. Then, same as with the land, you have to pay the unpaid taxes prior to the date of acquisition. Then, for example, the building has a tenants, then you're going to pay the tenants. Then whatever is the cost that you will going to induce tenants to vacate the premise or to vacate the building, that will also be included as part of the cost of the building. Then you will include cost of getting the building to its condition for you to use the asset. For example, you have to incur remodeling, renovation, or other repairs for as long as it is prior to the occupancy. Because once you have occupied the building, then that will not going to be a part of the cost of the building, but it will be considered as part of the improvements of the building. So again, the unpaid taxes and the cost of remodeling and renovation, that should be before the occupancy and before the date of acquisition. Now let's talk about the exclusions. Same as with the land, so if it's being sold for the ordinary course of business, that will be considered as part of inventory. Then if it's being held for sale but under PFRS 5 or non-current asset held for sale, then if it's being leased out under the operating lease, or it is being leased out for future use as investment property. If you can see this indication, then you can have an understanding that these kinds of building will not going to be included. Then let's talk about the self-constructed asset. So again, the self-constructed asset is that this is your alternative if you don't want to acquire or if you don't want to purchase a building. So let's talk about the inclusions here. So if you're going to construct your own assets, then the materials, labor, overhead will all be included on this one. Then we will going to add any professional fees that are directly related to the construction of the building. Then you will include the excavation costs. Then you will include any insurance or the cost of temporary structures and the interest on borrowings. Take note that the borrowing cost that we are talking about here is the same as borrowing cost under the specific and general loans directly related to the self-constructed asset. Then the temporary structures that we are talking about here are the safety fences, construction offices, and other structures. Now let's talk about the exclusion for the self-constructed asset. Again, we're going to exclude internal profits. Then we're going to exclude any abnormal amounts. The abnormal amounts that we are talking about here is related to the wasted materials and labor and other resources due to inefficiencies. All of those will be recorded as part of the expense. We will not going to include the cost of private driveways, walkways, and other permanent fences. So if you're going to see the fences that are temporary, those will be included. If the fences will be continuously used by the asset after the building will be constructed, then that is a permanent one, then that will not going to be a part of the cost of the self-constructed assets. Now, let's talk about the building improvements. So basically, when we say building improvements, these are the costs that you have incurred subsequent to the occupancy. So the keyword here is subsequent to occupancy. Then let's talk about the inclusions. So it will include the cost of elevator, escalators, the ventilation system, and other immovable fixtures. So if the building improvement is a movable fixture, then that will be classified as furniture and fixtures. But it will not be going to be classified as building improvement. So that will still be part of the past 16. That will not going to be total or included in the sum of the building improvements. So these are the inclusions and exclusions for the building, whether it is purchased or self-constructed, and building improvement. Let's talk about equipment. This will include transportation equipment, office equipment, regardless of whatever is the function of that office. So that can be part of the operations, or the office can be a part of the administrative function. For example, we have there a computer, and that computer is being used in the operations and in the general offices, general and admin offices. Then all of those computers from the two departments will be measured under PAS 16. Let's talk about the inclusions for the equipment. We have here the purchase price. We have here the assembling cost or installation cost. Then we have here the testing. And we have here the initial estimate for decommissioning and restoration costs. These are the inclusions for the equipment. If we're going to look for the purchase price, then please take note that again, we will going to include any commissions, but we will going to exclude any refundable purchase taxes. Let's talk about exclusion. First is that we're going to exclude cost of relocating the equipment. We're going to exclude the cost of training of the personnel who will going to use the asset, and of course you're going to exclude the cost of dismantling and removing an old equipment. Let's talk about bearer plants. A bearer plant is a living plant that first, it is used in the production or the supply of agricultural produce. Second, it is expected to bear produce for more than one period. Then the last one, it is the most critical one, is that there's no likelihood that bearer plants will be going to be sold as an agricultural produce. Let's talk about the accounting treatment for the lump sum price under PAS 16. So the acquisition cost of a group of items of PPE acquired on a lump sum, when we say lump sum, that is equivalent to a basket price. If we're going to have a basket price on this one, take note that for all items or all PPE purchased on a lump sum basis, we will going to allocate it based on their relative fair values. When we say relative fair market values, we are going to look for the fair market value of each kind of assets. Then we're going to have a ratio and proportion on that. Then we're going to multiply it on the basket price. So our formula here is that we have here the fair market value divided by the total fair market value. This fraction is the relative fair market value multiplied by the basket price. So this is your formula when you will going to solve for a lump sum purchase items of PPE. But for example, the basket price includes only one land and one building. And for example, the building becomes unusable. Then from this perspective, only allocate the lump sum price to the land. Okay? But for example, there are multiple number of land and building. But the land and building are classified as inventory. So in this case, if land and building are to be classified as inventory, the lump sum acquisition cost should not be allocated. Again, if only both of these are inventory or investment property. But in terms of presentation and disclosure, you will recognize the land and building to be classified as investment property measured as cost. Let's talk about the accounting treatment for the demolition cost for PPE. So again, the demolition cost for PPE will depend on the reason of demolition. So for the first case is that we have to construct a new building. So if you're going to construct a new building, therefore the cost of demolition or raising the old building will qualify as the cost of site preparation. And that will be a directly attributable cost to the construction of the new building. So now, if the demolition cost is a directly attributable cost, then we can safely say that this demolition cost will be capitalizable cost for the new building. Since we have demolished something, so any proceeds from the sale of the salvage materials will be deducted from the demolition cost. Okay? So we have here the demolition cost. Then any proceeds will be deducted, then the net demolition cost will be capitalized. Since we are in the perspective of the expenses or of the cost, then any profit that will be an inflow to us, then that will be a deduction or it will reduce the amount of cost that you're going to incur. The second scenario is that if we're going to clear the land for a possible future sale, take note that it will only be capitalized if and only if it will enhance future economic benefit. So if there is an enhancement on the economic benefit of the land, then that will be capitalized. But if there's no future economic benefit enhancement, that will be an outright expense. If the decision to demolish occur prior to the classification as land for sale, then the demolition cost will be treated as cost to sell. Then, for example, there is a decision made prior to the classification under PFRS 5 or non-current asset held for sale, then the demolition cost is to be treated as cost to sell. Let's have an illustration for the lump sum price if the building is not demolished. On April 1, the company purchased land and building by paying 10 million pesos and assuming mortgage of 2 million pesos rather. The land and building have fair values of 5 million and 10 million respectively. Then the following are the costs that will be incurred. So the first one is that the legal cost of conveying and registering the land amounting to 8,000 pesos. The payment to tenants to vacate the premise, that will be 9,000 pesos. Option paid on the land and building, total amount of 6,000 pesos. Then the broker's fees on the land and building, 15,000 pesos. Unpaid real estate taxes prior to the acquisition, 30,000 pesos. And the real estate taxes after April 1, that will be 20,000 pesos. Then the repairs and renovation costs for the building. So we have here the repairs before the occupancy and the repairs after the occupancy. Let's try to solve the problem. So in this case, we have here the cash payment of 10 million pesos. Cash payment. Again, that is 10 million pesos. Then we have here the mortgage assumed. That will be 2 million pesos. So if you're going to total both of these, this is your total basket price or this is your total lump sum price. And that will be amounting to 12 million pesos. And these 12 million pesos that will be going to be allocated based on the fair market value of the land and the building. For the land, we will develop a fraction of 5 million over 15 million, or simply 5 over 15. And for the building, we will have here the ratio and proportion of 10 over 15. If you're going to allocate the 12 million pesos, then that will be 4 million pesos. For the land and for the building, that will be 8 million pesos. Now let's consider the additional cost. The legal cost of 8,000 pesos, that will all be exclusive for the land because it has nothing to do with the cost of the building. 8,000 pesos. Then for the payment of the tenants, take note that for the tenants, you will going to allocate it based on the land and based on the building. So we have here 9,000 multiplied by 5 divided by 15. 3,000 pesos will be allocated to the land, then the remainder of 6,000 pesos will be allocated to the building. Let's have here the option paid on land and building. Since both of these assets benefited from these expenses, then the 3,000 pesos will be allocated to these two. Since both land and building benefited from the option paid amounting to 6,000 pesos, that will be allocated to these two assets. 6,000 multiplied by 5 divided by 15, you will get 2,000 pesos. Then for the remainder, 4,000 pesos that will be allocated on the building. The next one is that we have option paid on land and building, but they are not being acquired. Then the option will be treated as an outright expense. Let's talk about the broker's fee. For the broker's fee is that we have 15,000. Then both asset of land and building benefited from it. Then the 15,000 is to be allocated. For the land, that will be 5,000 pesos. Then for the remainder of 10,000 pesos, that will be allocated to the building. Then for the unpaid real taxes of 30,000 pesos, take note that under the PAS 16, we will only record whatever is the unpaid taxes prior to the date of acquisition. Since this is related only to the land, this will be exclusive to the land, 30,000 pesos. The next one is that we have here 20,000 pesos, but take note, this is after April 1, so we will not going to record it as part of the cost under PAS 16. We have here the repairs and renovation cost before the building is being occupied. This will be exclusive to the building, 40,000 pesos. Now let's have the total for these two assets. We have here 4 million plus 8,000 plus 3,000 plus 2,000 plus 5,000 and plus 30,000. That will be equal to 4,048,000. Then for the building, we have here 8 million plus 6 plus 4 plus 10 and plus 40. We will get 8,060,000 pesos. To summarize this illustration, so first is to get the correct fair market value relative price. Then multiply it to its basket price. Then if both assets benefited from a specific cost, then you should multiply the specific expense or cost on its relative fair market value. But take note, all of the costs that we will be talking about here is prior to the occupancy or before the building is to be used for its intended purposes. Now, after or beyond that date, all of the costs from there on will be recorded as an outright expense. Let's have the illustration 2, wherein the building was demolished. On April 1, the company purchased a land and building by again paying 10 million pesos and assuming a mortgage of 2 million pesos. Then we have here the additional costs. We have the title guarantee, option paid, payment to tenants to vacate the building, cost of raising the old building or our demolition cost. Then we have here the proceeds from the sale of salvage materials, the fair value of the salvage materials, and the construction cost of the new building. So there are additional information on this one. The fair market value of the land and building, same as with the illustration number 1, we have 5 million and 10 million respectively. And the old building is unusable and has an insignificant fair market value. So let's try to solve this illustration. So again, the first thing that you have to remember is to come up with a proper fair market value relative sales price or fair market value fraction. The first thing that we have to do here is to come up with a correct relative fair market value fraction. So in this case, we have the land, we have the column for the old building, and we have the column for the new building. Okay? So for the land, we will going to use a fraction of 5/15. Then for the old building, we will going to use 10/15. Let's have here the total acquisition cost. Let's bring it back. So in this case, we will going to multiply the 12 million pesos by 5/15 and 10/15. We will get the exactly same answer as with illustration number 1, 4 million and 8 million pesos. Then the title guarantee will be an exclusive cost of the land amounting to 20,000 pesos. Then for the option, that will be allocated to the two assets, to the land and to the old building. So we have here 2,000 pesos and 4,000 pesos. Then payments to vacate the tenants of our asset, that will be allocated to both land and old building. So we have here 12,000 multiplied by 5 divided by 15, 4,000 pesos and 8,000 pesos. And for the cost of raising the old building, 60,000 pesos, it will be capitalized to the new building. Then for the fair market value of the materials, 30,000 pesos, that will be considered. Then for the proceeds from the sale of salvage value, 15,000 pesos, that will be a reduction to the old building, that will be a reduction to the cost of the new building, 15,000 pesos. Then for the construction cost, that will be 8.5 million pesos. Again, just to highlight the difference of illustration 1 to illustration 2 is that we have here the concept of demolition cost, which will be added to the cost of the new building. And we have here the proceeds from the salvage value of the assets or salvage value of the materials of the demolition cost amounting to 15,000 pesos. If you're going to run down the total, for the land, we will have here 4 million plus 20,000 plus 2,000 plus 4,000. We will have here 4,026,000. For the old building, that is 8 million plus 4,000 plus 8,000. We will get 8,012,000. And for the new building, that will be the total construction cost, 8,500,000 plus 60,000, less the net proceeds from the sale of the scrap materials. That will be 8,000, or sorry, not 8,000, but 8,545,000 pesos. We have for the land 4,026,000. For the old building, we have 8,012,000. And for the new building, we have 8,545,000. That's the end of the first part of our discussion for the property, plant, and equipment. Thank you all for watching.